Welcome to the Broken Pie Chart Podcast, episode 309. I'm your host, Derek Moore. With me this week is no one. You just got me. As again, Jay, our plan is to get the band back together maybe in February. More to come on that, though. But just solo this week. Lots to talk about. This week, it's a big week. Kind of a big deal. We have Tesla after the close, earnings after the close Wednesday, along with Meta, Microsoft. I'm looking at who else here. Levi's? I don't know. Does anybody care about Levi's earnings? I don't know. Just looking at Boeing before the open on Tuesday of this week. Starbucks after the close on Tuesday. I'm just looking at my list here. Who else? Oh, yeah. Yep. Let's see. UPS, MasterCard, Visa, all Thursday. MasterCard and Visa are interesting because sometimes you get a little bit of a tell from the economy because they're running most of the transactions. UPS, because it's about shipping data and how much of that is going on. Friday, let's see, Exxon, Chevron. Who else? That's some of the big ones. Intel, it's so funny because they used to be the company. I remember in the 90s, they were the company. And I don't know. I don't know what to tell you about Intel. All right. I don't know what the stock is going to do, but it's just a fallen giant, in my opinion. And it just kind of is what it is. So a couple of things. One of the, I really want to talk about hedging. And Michael, one of our longest listeners, sent me a note about hedging being a sucker's bet. All right, actually, let me get the actual headline. What was it? Downside protection is for suckers. So an article. I'll talk about that. Appreciate Michael for sending that over. Thanks for listening. And I got a couple other things I definitely need to cover. I did see something. All right, a couple things. Michael McDonough over at Bloomberg. So you know how I make fun of CPI, you have CPI, you have CPI X food and energy, and then you have Supercore, which is basically X food and energy, X housing, X, there's X housing, that's Supercore. Well, he's come up with another one. It's the Bacon, Egg, and Cheese Sandwich Price Index. That's right, folks. Bacon, Egg, and Cheese Sandwich Price Index. And he mentioned on X that it's up 40%. So the cost of the bacon, egg, and cheese sandwich is up 40% since 2020. And I'm looking at a chart. I'll actually, when I post this on ZegaInvestments.com, I'll take a screenshot of this and I'll put it on there. But he puts out some pretty interesting stuff from Bloomberg. And I mean, it's not as high as it was. I'm just looking, what is this? January 31st of 2023. But it's getting up there. To put this in perspective, right now it's 251. This is the index. And this goes back to, is this 1995? Yeah, it would have been about, let's see. What is that? What is that in about 0.85. So I don't know if that's like the cost or, well, like the CPI is an index, but the CPI is not, the cumulative dollars for everything. So it's probably indexed to something. But yeah, I mean, eggs are rising. Bacon prices are rising. Let's see, what else? Is cheese rising? Yeah, cheese is up there too. So the bacon, egg, and cheese index this will be one of those maybe you watch for a little bit. And, we'll come back to it. So, all right, we mentioned earnings. We mentioned the bacon, egg, and cheese index. Speaking of earnings, by the way, when you look at earnings estimates, and what I would tell you is that they are, for full fiscal year 2025, they're saying it's about 272.37 per share. I will tell you that is not as high as it was back in August. So August, let me see what this was. it was only a little bit higher, I guess. And then the 2026 estimates, I think, almost hit a new high, 305.83 per share. Remember, the index is, you have all these different companies that are in the index, and all of the earnings get aggregated together, but they're on a per share basis as well. Earnings really, Netflix killed earnings. You've had some pretty good earnings from from TSM, and that's in the semiconductor space. Semis definitely got a boost this week. A couple of weeks ago, we were on with Spencer Wright. He was talking about that consolidation pattern in semiconductors, and with some of the news and some of the earnings, those have, I don't know if they've broken out completely, but it's looking a little better than they were. So I think the point is, for all the talk about this or that, it still in many ways comes down to earnings. We don't know what the market multiple will be, and we still don't know what earnings will be in the future because those are estimates only. We don't know if those will actually come in the way that the analyst estimates can go up, they can come down. But the market multiple is still, when we think about where it's 23.17 times forward 12-month estimates. So it crested the 23, and we're not low. And we know that there's some studies where you look at sort of the 1 year later based upon different forward multiples. And it's not a great predictor of where the market's going to be. 5 years out, 10 years out, it's a little bit better. And we'll get to hedging. That's one of the arguments to have hedging, because if you do have a material significant pullback, hopefully the hedges will buffer that. I shouldn't use buffer. They'll hedge the downside. Buffer, we'll talk about buffers too, but buffers, the way we look at them, are a little bit different. But yeah, in the forward, if earnings continue to be strong, that would certainly be a positive for stocks. Of course it is. So it's just kind of one of those things that you look at. All right, let me go to hedging though. And in fairness to the site Zero Hedge, I'm not a subscriber. I didn't want to necessarily subscribe just to read this article. Apparently they're saying it's so good. They said, this is so good, it's for premium members only. Does that sound like you? And so anyway, I did not subscribe to this. But the headline was, downside protection is for suckers. I hear this a lot. And so, downside protection, when you think about what is that? It means you either, all right, let me just get into it. And what I would tell you too, it really fails to individualize each person's situation. Like when you see a head, and in fairness to Zero Hedge, I can't read the article because it's behind a paywall, and I'm taking it totally out of context. But all I'm doing is reacting to the headline. But when you have somebody who's saying something like that, and I've heard this before, where they say, well, why hedge, or it doesn't make sense, or you just would have been better off holding, owning the market. Well, it fails to really think about somebody's circumstances. Imagine someone is right before retirement or in retirement. And you might say, well, why do people still have equities in retirement? Because a lot of times you need more growth. Good news is people are living longer. The bad news is people are living longer. What that means is your assets have to continue on and fund your lifestyle for a longer period. Plus, there's inflation. We just came through a period of high inflation. We're not at 2% again. We're not below 2%. So there's still some inflation. But here's the thing too, there's different types of hedges. Somebody could hedge by diversifying into different asset classes that you're hoping are non-correlated. Although in 2022, I'm talking about the 60-40 portfolio. And 60-40 is you own equities, but you have 40% in bonds, and who knows, which duration of bonds, whether they're long-term bonds or. But here's the thing. Somebody doing a 60-40 portfolio, that 40%, and basically what they're saying is they'd rather own equities, but they'd rather probably own all stocks. But in order to cut the volatility, in order to quote unquote hedge some of the risk out, they would use 40% in bonds. And the idea is that if stocks are going down, there's a flight to quality, interest rates come down, maybe the Fed is cutting interest rates and some sort of market event, that bonds would appreciate in value. But when you buy 40% of bonds, you are essentially making a decision to sell stocks or sell equities, sell the S&P 500. That's kind of what you're in. So you're selling equities to buy bonds. But what's interesting though is I don't see, I've seen, articles about, the death of 60-40, what's wrong with 60-40 2022 when interest rates are going up, which was causing the problem. We know that bonds did not do well. If you bought 30-year treasuries in January 1st in 2022, you're still down. You're probably not getting your money back for some time, meaning maturing it at par or going back to the previous level that you did, that you had those at. The AGG, the U.S. Aggregate Bond Index, it's still in a bear market. It still has not gotten back to its old high from pre-2022 collapse. It's doing better. I mean, part of that is yields are up. So unlike when yields were near zero, especially on the short end, weren't really getting paid to take any of the risk. But there's other things you can do too. You could add gold. You can add different strategies that are supposed to do other things or be non-correlated. We have a couple of these. We have a strategy I call decades. It's actually, at some point it will be listed on our zegainvestments.com. But that's a kind of a portfolio that my version of an all-weather, and we use different things in there. But again, you're selling something to buy something else, and that may be an appropriate portfolio. The other one that you hear about, and maybe this is what the article is hinting at, I don't know though. Again, I'm not a premium subscriber, and the article is so good that they had to put it behind a paywall. But black swan protection. Black swan protection is where maybe a fund is buying very, very far out of the money put options on maybe the S&P 500. And those generally have a low probability of ever being hit. And you hope that. I mean, the market's up more years than not. And typically, after 2008, 2009, there were quote unquote black swan funds that came out. Some of those closed. There's still some that are around in various forms. But the idea is basically those would lose money every year because they are very low probability and they're more like crash protection. There's maybe another show we'll kind of go through why or why not those are a good idea, because some of this too depends on, you put on crash protection, and when does the market actually crash? When does it, between the time you put it on and expiration? And so that's one of them. The way that we like to hedge, we have a strategy called Buy and Hedge Classic, and you can go to our website, zegainvestments.com, and read about that. And send me an email if you want, derek.moore@zegainvestments.com. That's DEREK.MOORE @Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. If you can't get that right, not going to be able to reach me via email. Send emails though. We like getting questions, and always like hearing from listeners. And if there's something we can help you out with on the investment side, we do manage individual portfolios, and we also have a lot of advisors who use our strategies. That's kind of and separately managed account form and other forms. So I'd love to hear from the listeners. But the classic version, kind of the classic hedging that we do, is this idea of, rather than selling, let's say in the 60-40 example, where you're selling 40% of your equity exposure, maybe in the S&P 500, and instead you're buying bonds, the classic hedging approach that we're using right now is you're buying sort of more of what you quote unquote want. And by want, I just mean that's, individualized, but it's, if you want equities, you buy equities, maybe the S&P 500. And we prefer to buy the S&P 500, and which is diversified in itself. And when we do that, we take a small sliver, and the annualized cost of hedging right now is right around 3%, and it's fairly cheap. And we buy maybe a put spread. And the case, a good example of that is maybe at the protection starts at 3%, and from 3% down to about 25%, you are hedged. And what do you give up? Well, instead of being invested, 100% into the S&P 500, you're maybe around 97% in the S&P 500, and you got a small carve out for a hedge. And the hedging protection starts fairly high. Usually, sometimes it's at the money. Sometimes it's a few percentage points starts lower. And I prefer that. I really like that construct. And the reason why I do is that, number one, the protection starts fairly close to where the current price is. And you can remain more in equities, more of the stuff, quote unquote, that you want. And so, is that a bad idea? Is that for suckers? I would argue it's not. And the reason why is, when I see people say that hedging doesn't make sense, it doesn't make sense for who? Does it make sense for you, the person saying that? Or does it make sense for someone who has considerable assets and says, I want to make sure and sleep a little better at night. I want to hedge my downside in this portfolio while still trying to strive for growth. Is it a sucker's bet for them? I would argue no. This has to be really individualized. And that's one of the things that not only the advisors that we work with who use our strategies, but our individual wealth clients, that we actually go over this stuff with them. Because someone who is very, very young might say, well, why would I hedge? And they're probably right. A lot of times I'll tell very young investors, you really don't need me yet. Invest in the S&P, do index funds, the NASDAQ 100, the S&P 500, and you should focus right now on building up your investments, and you should focus on contributing to those investment accounts, because some of the biggest gains that you will have is when you contribute more money. Later on, when you've got considerable assets and wealth, then it really is paramount to start saying, well, how do you protect that while still trying for growth? And so, you're not necessarily, and this is the other thing, I've seen studies that say, well, if hedging is, you won't make as much. You're not going to beat the market, or you're not going to match the market. And that may be true. Certainly on the upside, if the markets have a very strong year, you do give up something. And there's a trade-off. You capture most of the market, hopefully, market upside, in exchange for protecting the downside. Now, in theoretically, in really bad markets, if a market's down 25% and you've got a hedge on, let's say maybe from the 3% level down to the 25%, well, you feel the first 3%, there's cost of hedging, but then you've got hedges on. And if the market's down, in theory, you would outperform the market. And there's also an interesting thing too, is we call it the hedger's opportunity, where let's say that the market is down and what you have bought, what you have purchased, that protection, put spreads, things like that. If those are going up in value while the market's going down, offsetting the downside, well, the hedger's opportunity says, well, at some point, maybe I'll to monetize the hedges, meaning cash them in or sell them, and use a portion of the money to re-hedge, but a portion of that to add to your underlying investment, in this case, the S&P 500, at lower levels. So that's kind of the hedger's opportunity. So the key thing here is you're not trying to beat the market. You're trying to get what you need. You're trying to set yourself up to still have growth, but at a risk level that makes you comfortable. Makes you comfortable, maybe makes you sleep a little better at night. And when people say hedging is a sucker's bet, then I guess they're saying that they would be saying the same thing about a 60-40 portfolio or adding gold or adding diversification. Because if you look at the historical numbers, and we know that past performance is no indication of future results, certainly. When you look at the historical numbers, stocks kind of for the long run, as Jeremy Siegel's book, Stocks for the Long Run, I think it's now in its third edition. I'd have to look on my bookshelf. And he goes back and he looks at the performance of stocks over, I think it's like 200 years. And he looks at the growth of the dollar and in stocks and gold in quote unquote in US dollars and in bonds. And stocks historically have performed better. And so if that's the case, then it's the same thing of, don't add gold, don't add bonds, don't add anything. So I think the point here is, so thank you, Michael, again for sending that article over that, of course, I couldn't read. But downside protection is for suckers? I don't think so. I think it's really individualized. And if you get what you need out of the markets, that is a very, very good thing. All right. Speaking of markets, I saw an interesting, where is this here? I know I have it somewhere. We talked about earnings. What do we want to go next? All right. Jeff Weiniger had put this out on X. I'm trying to remember where Jeff is. Jeff at Wisdom Tree, right? He's over at Wisdom Tree. And what he put out was the CPI is overstating rent. Okay. He said, quote, full stop, that's what's happening. Rent shot to the moon in 2021 and 2022. And the BLS, that's the Bureau of Labor Statistics, calculation is still catching up even to this day. And what he had posted is inflation in the last 12 months, CPI rent, that's the official one, is up 4.3%. On Zillow, no increase. Redfin, a decline of 0.3%. And on apartment listings, I guess that's a site, yep, minus 0.6%. And so the CPI version is what they call rent of a primary residence. And that's consumer price index for all urban consumers, U.S. city average by expenditure category. This was through December of 2024. So that's the most recent one. And let's see. The weight in the CPI calculation, so rent of primary residence, actually makes up 7.75% of the total CPI number. So that's its weight in that headline number. But it was reporting a 4.3% annual rent inflation. So his point is that he thinks, or he is kind of showing or making the argument that when you look at Zillow, which is, Zillow rentals data, maybe more of a real time, there's no increase. They're saying the median rent was $2,000 for all bedrooms and all property types in the U.S. And that was as of, the 601,000 available rentals. Redfin, let's see if it says U.S. asking rents ended 2024 at the lowest level in nearly 3 years. And Apartment List, National Rent Report. Yeah, and I like this one too, because here's the thing. Although it is, they're showing there's decline year over year. If you could see this chart, and maybe I'll take a screenshot of this chart and put it in when I post we post the episode to zegainvestments.com. But when you look at 2021, the average of the median rent was about $1,150. I'm just kind of eyeballing this at the start of 2021. And now it is $1,373. So it's not close to where it was in 2021. So it's still up. But I think the point is that we're not seeing year over year increases in these other sources. So that's something to watch. We know it lags. And part of it is because not every apartment comes up at once. There's sort of a lag effect. And, I guess the other thing, though, is it was probably lagging going into 2021. In other words, it probably didn't capture how much rents were increasing and took a little time to catch up in that regard, too. So something to watch there. We'll keep an eye on it. All right. The other thing I wanted to point out was, if I can get this chart up, and Ritholtz Wealth had put out a chart. I saw Ryan Dietrich had tweeted this on X or X'd it or whatever you do there. And it was time spent in recession by decade, percentage of time spent in a recession. And this is kind of an interesting chart. So in the 2020s so far, we have spent 3% of the time in a recession. So, and basically, if you think about the 2020s, we're talking about 2020, where basically, what was that? Is that April and May, probably, when they did the shutdowns? 0% of the time in the 2010s. So spent no time in a recession. And going back to the 1900s, so 1900s, 1910s, 1920s, all these decades, that was the only decade that didn't have any time in a recession. The 2000s, it was 22% of the time. The 90s, 7%. What I would say is when you look at a chart like this, really from the 1990s to the 2020s, the 2000s was 22% of the time. But we haven't really been in a recession that much. And Ryan Dietrich's quote was a good one. He said, over the past 15 years, our economy has been in a recession for only 2 months. Now think about how much time is spent worrying about it. It's not wrong. Remember in start of 2023, Jay and I talked about, I think it was in Barron's, or it might have been Barron's or another article or publication, 29 out of the 30 leading economists said we were almost certain to be in a recession in 2023, and it didn't happen. So I will tell you, too, from 1900s to 1930s, it was time spent in a recession was anywhere from 36% to 45% of the time. So back then, it wasn't half, but it was, I'd say, on average, 40% of the time was in recessions. And here we are, 3% of the time so far in the 2020s, which I can't believe we're, 20, 21, 22, 23, 24. Yeah, we're already halfway there because 2020 plus, 2020 through 2024 is 5 years. So we're already halfway there. And we only spent 3% of the time in a recession. So I just found that interesting, and it was really more about Ryan's quotas. Now, for all the time we worry about being in recessions, how little time we actually spend in a recession. Finally, we mentioned some earnings coming up, and it's always interesting to take a look at the options volatility, the implied volatility through earnings, the January 31st expiration, which is what? That's next Friday. So this Friday, and Tesla. And if we take a look at Tesla, the at the money implied volatility is right around 85. So what does that mean? Well, there's earnings on Wednesday, and so the January 31st is the expiration that will include the earnings announcement. We know that earnings announcements always can cause some volatility, and the options market is trying to figure out what is the right implied volatility to sort of sketch out what the one standard deviation move is. Like, how much will this stock potentially move? And the higher the expectation for movement, the higher the amount of implied volatility. So if we kind of look and we say an 85 volatility would imply a one standard deviation move up or down of about 5.35%. 5.35%. So, and there's 5 days, 5 trading days that are basically, let me see, 5.4. Yep. So that's about a 12% one standard deviation move that's being priced in right now through the 31st, because there's 5 trading days there. But all right, so is 85, is that a big amount? Consisting, figuring that earnings are coming out. Let's take a look at Microsoft. So Microsoft is kind of, they might be the same. Did I say the same day? Their implied volatility is only 36.27. So the options market is saying they're expecting less potential movement from Microsoft than they are from, let's see. I'm going to look at Intel too. So I just kind of said they were, okay, Intel was about 84% implied volatility. So the options market is pricing in a big move there. Who else did I say that was, Apple. How did I forget Apple? Yeah, Apple after the close on Thursday. And Apple of late, though, their implied volatility has not been as high. In fact, for next Friday's expiration, about 41% implied volatility. So the way that you do this is you take the implied volatility divided by the square root of time. And by square root of time, it's the number of trading days in a year. So the square root of 252 is about 15.875. You take the implied volatility of 4130 in this example, divided by 15.875. And it's saying about a 2.6% expected one standard deviation move. Now, I told you that there's 5 trading days until the end of, the January 31st is when this Friday, as you're listening to this, it expires. And so if we look at, what did I say, about 2.6% was the implied move. Well, if you take the square root of 5, which is 2.24 rounded, times 2.6, basically it's pricing in a 5.8% implied one standard deviation move up or down over the next 5 days. So that's kind of that's the quick math behind it. But you get it. If the options market is expecting something to move, the options will be pricier. They will be more expensive. So then the question comes, okay, well, what do we, I always talk about the straddle. So what is you think, I'm going to buy options on Apple because I think they're going to move a lot. And, if we, let me just get this here. I think they're going to move a lot and I think I can make money, so I want to buy or sell options. So what exactly does that look like? So, and don't necessarily, I'm not saying to do this trade. All right. If you want to do it, do it. If you don't want to do it, don't do it. But buying a straddle or selling a straddle around earnings is actually a risky trade because it's a bet on volatility and direction. And either one of those can hurt you. So honestly, don't try this at home. If I take a look at the 222.5 strike price and I say, well, what if I bought the call for $5.40 and I bought the same put for right around $5? So it's $10.40. And so what does that mean? If you bought that, let's say even the day before, or you bought it now, well, the market has to move $10.40 just to break even, meaning Apple has to go up or down by about 4.7% just to break even. And so if you're a buyer of that, you think it's going to go up more than that. If you don't believe it and if you sell it, and I wouldn't sell it because you'll be naked on the call side, which has unlimited loss potential, then you're saying, okay, I don't think it's going to move that much. And here's the other thing too, is you could be right, but volatility could collapse. You could be right in the direction, but not right enough, and volatility could collapse and you could still lose money on it. So I bring that up. I always sort of throw that caveat in. Straddles is one of those trades where early on in options traders' lives, they say, well, I know it's going to move. I know it's going to move because of earnings. I'm buy the straddle and I know I'll make money. Not necessarily. The options market's smart. The options market is pricing that in. They know something's going to be volatile. Is the option market right or wrong? Well, we'll find out on Thursday, or actually on Friday when the stock opens again. So, but I do like to look at those, and it's always interesting to see what the options market is forecasting. I will tell you, Apple is an interesting stock too. We run some concentrated stock management for advisors, where let's say somebody has a lot of Apple or a lot of XY. I can't use XYZ anymore, and I'm actually kind of mad about this. So I think it's Square. Square is changing their symbol to XYZ. So if you've ever heard me on a previous podcast throw a hypothetical on a totally fake company called XYZ, well, I guess now XYZ is going to be a real symbol. So ABC, I guess I'll have to switch to ABC or some other fictitious symbol. But when you look at earnings, or rather, no, I was talking about concentrated stock. There we go. Thank you. See what happens when I don't have my co-host with me. So we're thinking about concentrated stock, and somebody has a boatload of shares, and maybe they have a low basis, and they're trying to generate income, or they're trying to hedge it. I can tell you that it's having had to hedge some pretty large positions of Apple. On a relative basis, Apple is fairly cheap to hedge. It is, you think about an individual company, and Apple has moved around. Apple's an example of where it's historical volatility, meaning how much it has actually gone up or down compared to the implied volatility, what the options market is forecasting. It has been more volatile than the options market has forecasted, at least in my experience over the last 6 months or so. What's going to happen with earnings? I have no idea. So you're on your own there. I'll let you know when I know. All right, that's it for this week. Keep the emails up. Appreciate the emails. And if you have a second, go onto Spotify, or only if you can do like 5 stars. But go onto Spotify or Apple and give us 5 stars. You know what? Or don't do that. Share the episode with someone. We always like when our listeners share episodes and recommend us to other people. And that's how the show grows. That's how the shows continue to grow. And people have asked me, I'm surprised you guys don't take advertising. We never have. And it's not because I'm against it. It's just when I listen to podcasts and they start and you go right into, now a word from our sponsor or this and that. I just fast forward through that stuff. So, and I will tell you, we have been offered sponsorships. Different groups or companies have offered to sponsor. We've been offered paid placement where people would pay to come on. And I haven't done it. So no plans to do it anytime soon. I just want to continue talking directly to the audience without any of that stuff. And with that, we'll pick it up next week, and we'll see you then.